Hello, good evening, everyone. Welcome and thank you for dialing in to our webinar today. My name is Mu, your moderator for this webinar. Today, we'll be sharing a topic entitled Goldilocks of Inflation, Investment Opportunities Amid Heightened Uncertainty. Ladies and gentlemen, 2022 has so far proven to be a highly volatile period for investors, driven by rising inflationary pressure, US Fed embarking on a monetary policy normalization path, the Russia-Ukraine war, and persistently high COVID cases globally. Given the heightened global challenges and increased market volatility, I'm sure you will be keen to seek the appropriate investment opportunities to ride through the current wave of uncertainties while optimizing your investment return. Tonight, we are pleased to have Mr. Wong Kim Kian, also known as Kian to us, is our head of retail treasury sales with Alliance Bank Malaysia, joining us today to address these and other pertinent issues. Kian has been with Alliance Bank for more than 9 years as head of retail treasury sales. He is responsible in setting up the retail treasury desk to cater specifically to the needs of our high net worth individuals. In his tenure in Alliance Bank, he introduced numerous structured products covering various asset classes. Kim Kian has over a decade of experience in treasury products, focusing on sales and product structuring. Kian will be sharing the risks and opportunity that you need to know to help you navigate through the fast-changing macro environment and market condition. We are going to start the discussion session soon. You can type in your question in the chat box, which is only visible to us at the back end. And we will address as many questions as the time permits. So let's proceed with the discussion. Hi, Ken.
Hi. Hi, Mo.
Hi. Hi, Ken. So perhaps we shall begin the session by you highlighting the global economic outlook for 2022.
Sure. Thank you. Okay. Good evening, everyone. So I think today, I would like to actually, start the topic by talking about the Goldilocks of inflation, because as we all know, today the main topic that is being well spoken about is all about inflation. But before we actually go there, I think today I would like to also share how we have been doing last year and obviously moving forward in 2022 and also 2023. Last year, the world has actually achieved a GDP growth of 5.9%. And that, if you can see, is led by the emerging and also developing Asia. But United States is not doing too badly themselves, as they have actually achieved a growth that is actually higher than the prior years at 5.6%. Again, I think, of course, if you were to look at the Euro area and also the Middle East, globally, including Africa and also the Latin America, everywhere is showing growth after the COVID ravaged economies for the past 3 years. So over here, I think we continue to project a recovery path that is actually still pretty much intact globally. And this is where we find it the growth is being exponential, because if you were to look at the past global financial crisis, and this is actually the recent crisis that we have actually experienced in 2008, and if you were to look at the recovery that it actually took for the global financial crisis to be back at the potential, it actually took almost 36 quarters. Whereas if you were to look at the current pandemic, as the world actually came together by actually relaxing both the fiscal and also the monetary policy, we actually saw the growth actually recovering almost back to the path of the potential path in around 12 quarters. And if you were to look at where we were, the growth rate probably only took about 4 quarters before it actually matches the growth that we have actually seen, or the recovery that we have actually seen for the global financial crisis. So all in all, the steps and also the measures taken by most economies appear to be showing results. But over here, we are probably also asking the same question. Are we actually going too fast? Because inflation, as we will be seeing later, is definitely shooting up, on a red-hot pace. And talking about growth, I think if you were to look into all the emerging market growth, I believe if over here you can see, Asia will continue to lead emerging market. And over here, if you can see, emerging market Asia is actually excluding China. So China in itself, will be growing definitely very, very strongly, despite the fact that it has actually toned down the expectation of the growth. But again, it is still faster than a lot of the emerging market that we are actually seeing. And over here, we would like to just compare as what we have actually mentioned, that the output gap that we have actually seen actually practically vanished or destroyed in 2020. Of course, this is actually at the peak of the pandemic, and where most economies are actually telling the population that there is a lockdown or the economy is being locked down. And therefore, output gap actually practically crash. But I think as the market starts to reopen and try to find gaps and trying to find ways, we started to see recovery. But as we mentioned earlier, with the help of fiscal and also monetary policy easing, has actually helped the economy recover. But again, if you were to look at the core inflation, it has also been driven up to record levels. Although we are actually seeing it, or rather expecting to moderate in 2022, again, it is still far outpacing the output gap recovery that we actually see.
Thanks, Ken. All right, I think it's good that you have touched on the issue of inflation. All right, so because persistently high inflation is one of the key investor concern, and with the Russia-Ukraine tension have further exacerbate the situation. So could you shed some lights on the current inflation outlook?
Sure. Now, if you were to look at the inflation that we are actually seeing today, everywhere around the world, from developed markets, the DM, the blue line, emerging market, the Latin America, and also the Middle East countries. But of course, the Middle East is actually referring to the right-hand side of the bar. Everywhere around the world, globally, inflation is peaking and inflation is actually rising. And particularly, I think towards the end of the fourth quarter of 2021, we actually start to see, as economies reopen, inflation actually accelerate in a lot of the areas. And Asia is actually not spared as well. And if you were to look at developed markets, particularly in the US, the Europe, and also the UK, the rise in inflation has actually prompted the central banks to actually talk about, starting to tighten its monetary policy. And if you were to look at the main contributor of where all this inflation is coming, it's actually really coming from the food and also the energy sector. And rightly so, if you were to look at where petrol price or the crude oil is right now, I think this is really definitely the main component of where the CPI is actually being driven up by. And of course, energy is just merely a factor, or rather an input into producing food. If and when the energy cost rises, then obviously the end result, when you produce food, food prices will equally be rising, and that overall is contributing to the core inflation that is actually peaking, or rather spiking, as we speak. And again, unfortunately, I would like to say, is that then as we are grappling with rising inflation everywhere around the world, as the world actually step up into a new world, then the Russia-Ukraine war actually happened. And this is where we actually feel that this could actually be a trigger point for an inflation 2.0, or rather, before inflation 1.0 has really been settled. We are probably going to see the Russia-Ukraine war accelerating, or rather aggravating the inflation that we are actually seeing in the market today. And why? Number one, Russia and Ukraine, both of them actually account for 29% of the global wheat export, and on top of being also a major exporter of barley, corn, and sunflower oil. Ukraine themselves is responsible for 25% of global neon supplies, and 29% of their steel is actually exported into EU. Meanwhile, Russia is the largest global exporter of fertilizer already. Even before the war started, we are already facing a shortage supply of fertilizer. And with the war, we believe the situation of shortage of fertilizer is going to be aggravated even further. And that we have not even talked about, Russia supplying all the other relevant aluminium, the steel, the palladium, platinum, and all the other minerals to Europe. And lastly, to address the elephant in the room, Russia themselves is actually a major exporter of oil. Yeah, and if you were to look at where European Union, the EU, imports their oil from, they actually get almost 25% of their oil from Russia. So just imagine all this sanction that is really happening around the world right now, imposed by the EU, imposed by the US on Russia. The last thing that they wanted is to actually say, we will also impose sanction on the import of oil into EU. So far, if they were to do that, 25% of it, they will have to find somewhere else to actually fill. And that really is driving the oil market pretty strongly right now. And if you were to look at the gas, well, fortunately, we are not in the winter season in the EU, the European Union right now. If you were to look at the gas import, almost 50% of the gas is actually coming from Russia. So all in all, we are actually seeing the EU is likely going to be facing the strongest inflation spike as compared to the rest of the world. But if you were to look at the commodities that is being exported out from Russia and also the Ukraine, we actually believe the food prices, the food inflation will actually undergo another round of inflation.
Thanks, Ken. Right, let's move on to another major concern of investors, the COVID-19 pandemic, right? So according to WHO, the global daily cases are still rising, right? So do you think COVID-19 will continue to threaten the global economic recovery?
Sure. I think this is really definitely something that is pretty much close to our the heart right now. I think let's not deviate from the fact that most of us would have already gotten a vaccine jab, and right now I think the government is really moving for booster jabs and trying to, encourage more population to actually be boosted. And in fact, if you were to look at globally, I think with the Omicron hitting the global stage, we're actually seeing a spike of infection all around the world, as you can actually see over here. But we think the worst is probably over, and we are actually seeing, the Omicron wave probably would have peaked out of Asia. Even for Malaysia, I think the Omicron wave would have also peaked. Of course, there are talks about, the coming Puasa month and also the Raya festive could actually result in another, wave. But importantly, I think for Malaysia, we are actually moving into the endemic stage come 1st of April, and that is definitely not an April Fool's joke. So we are moving into the endemic stage. And importantly, I think where the government is also, coming in, they are not merely looking at the infection numbers on a daily basis. In fact, the focus point right now is really on the utilization of the ICU beds in hospitals. And if you were to look globally, a similar situation is also being seen as we are actually seeing mobility actually the mobility actually recovering from the latest wave. I think most countries are also opening up. New COVID-19 death is also falling off, and it's also moderating lower. Restriction is also being lifted around the world, and therefore, I think yes, will we be seeing more variant coming out? The answer is, I do not discount the possibility. In fact, as we speak, they are probably finding out another variant from another part of the world. But I think importantly, as the key point that we would like to take away here is really to say that, while infection is really still remaining high in most countries, in most part of the world, death rate is still manageable. The people that is who has actually gotten infected, that is actually hospitalized, those utilization of ICU beds is still manageable as well. Even for Malaysia, the utilization of the ICU bed is remaining below 50%. And I think that, definitely our healthcare services will definitely be able to cope, despite the fact that, the Omicron wave, or rather the subsequent wave, is going to result in a high infection rate.
Thanks, Ken. I guess I think the fear factors for our people is diminished over time with all the lockdowns that we have.
Definitely.
Right. Yeah. So let's move on back to our home country, Malaysia. So earlier you mentioned we are moving towards the endemic phase. So what's your view on our country's prospect this year? So are we expecting Bank Negara to hike interest rate anytime soon?
Right. I think with Malaysia, a lot is happening. But I think let's start off with how we have been doing, how we have been recovering from the pandemic. As we have known, at the start of, or rather the peak of the pandemic, I think in 2020, we are not doing too great. And in 2021, as we try to recover, in the first half of the year, the second quarter of the year, we scored a 16.1% growth before actually plunging to a negative 4.5. But all in all, I think we ended up the year on a positive note. And overall, 2021, I think we have actually achieved a growth rate. And going into 2022, we are actually forecasting between the 5.5% to the 6% growth for Malaysia. And I think looking at how we are actually moving into the endemic stage, I believe it is definitely possible for that to actually happen for us. But again, I think for inflation, as we have also shared earlier, Malaysia is no different from all the other emerging markets. And inflation is also spiking in Malaysia. Of course, crude oil is still capped for RON 95 is still capped. But food prices, again, as we mentioned and as we shared earlier, the cost of fertilizer has actually gone up. There's a shortage of supply, and that actually filter down to the cost of food production. And food is again driving up the inflation from Malaysia. And if you were to look at where we are, could the inflation in Malaysia, could it be worse? My answer to you is yes, it could have been worse if not for the government intervention in terms of subsidizing for the RON 95 gasoline prices in Malaysia. But again, as we speak, there are already talks from our finance minister that we are possibly looking at subsidies being given to a targeted group for the population. So it will not be open for all subsidies. And therefore I think when that actually happens, we believe good chance we could actually be seeing another round of inflation. Of course, as I mentioned earlier, we are actually seeing quite a few things happening for Malaysia, and one of the key things that we believe that is going to happen this year would be the general election for us, right? The GE15. So if you are going to ask, when do I predict, they will actually be lifting the subsidies? Possibly it will be after the general election 15, right? So if you were to look at where we are, where the CPI is, again, I think CPI is again rising, but OPR has maintained pretty much flat at the moment. But having said that, we also believe that we should be able to see one rate hike by the end of the year. All in all, we do predict or forecast 75 basis point hike for Malaysia over 2 years in 2022 and 2023. While we are probably unable to actually pinpoint exactly when the 75 basis point is going to be deployed, we do think that it is all dependent on how the Russia-Ukraine war continue to develop. It also depends on when the GE15 is going to happen. And definitely, I think we will actually see at least one rate hike by the second half of 2022.
Right. Thanks a lot, Ken. It seems like our depositor have to endure for a low interest rate environment for quite some time. So, given the projection that you have shared earlier, so I think 0.75% increase is quite marginal for us. All right. All right. So let's move on our focus to US. All right. So given the strong economic rebound and also high inflationary pressure, the US Fed has recently hiked interest rate for the first time in more than 3 years. So what's your interest rate projection for US?
Right. On the US, well, they have actually hiked, the first time, one time, in the March meeting. And in fact, they have actually mentioned that they will actually continue to hike. In fact, I think, the market actually see the Fed's comment right after the FOMC meeting as being bullish, being aggressive. Because I think one of the statement was that the Feds will actually do all they can to actually ensure that they are able to control the inflation. And as such, what is actually happening here is that we do believe the market is actually seeing US Feds to continue to hike every time they meet in the 2022. And therefore, we are potentially seeing 7 more rate hikes for 2022. But again, I think if you were to look at the what do you call the expectation versus the actual rate hike from US Feds, it might not actually happen spot on, right? So market expectation is for 7 rate hikes to happen, but that doesn't really mean that it is actually cast in stone. Again, I think as we can see from the Russia and Ukraine war, if inflation were to really blow out portion, we do want to caution clients that should growth suffers, then the US Fed could take a step back to actually reevaluate their position to actually see whether they would want to hike as aggressively as the market actually predict them to actually hike. As you can actually see from this particular slide, one is actually again a comparison between the US and also the emerging market. And of course, this is where we are always talking about, hey, you know what, US is hiking the interest rate. Shouldn't the global economies be following suit as well? And I thought I would like to actually use this particular slide to actually impress on all of my participants over here, that despite the fact that the US could actually be hiking aggressively, or rather potentially 7 more times this year, that doesn't mean that Malaysia, for example, as part of the emerging market, would actually need to follow suit and also hike as aggressively as US, because the market dynamics, the economic dynamics is different country to country. Yeah, and therefore, while we actually think Malaysia will hike in 2022, we actually believe the quantum is probably going to be less aggressive than the US.
All right, thanks, Ken. All right, I think you have shared a lot of market condition, all right, earlier. So I think most important now is for our investors, all right. Are there any investment opportunities for our audience to capitalize on?
Sure, I think that is something that I'm passionate about. I think that is where we would want to start. If you were to look at one of my, I actually have got 4 strategies to share. Number 1, keep it short, right? Keep it short. And this is where as things are being very dynamic, the dynamic in the market is really fast. And we're actually seeing a quick change in terms of direction. Just about a week ago, we saw the China equities crashing, but just 2 days later, it is backed up, more than 20%. And today, it continued to rise, and that is what we will probably, recommend to the client. First thing is keep your investment short. And where we can actually do this is actually via, dual currency investment, or actually the power DCI that, the bank have actually developed. And between the two, some of the clients is actually unsure, how does a power DCI works compared to a DCI. Is that if you were to look at the green line, the DCI, if you're holding Aussie currency, for example, right? And when you want to pair it against the US dollars, what you want to do is really to sell as high as possible. But if you were to look at DCI, the strike rate that we potentially can actually give to you, the wire DCI, is probably what, 50 basis point, 50 pips, right? But of course, you will get a coupon, the assured or guaranteed at 5%. But where the power DCI is striving to do is to actually push the strike rate further away, right? To allow the client to actually strike at an even higher value, right? At an even higher value, yeah. So in this case, we potentially can actually move it all the way to 100 pips. So therefore, instead of like, the hovering around the 74.50, which could easily be broken, because if you were to look at the volatility of on the Aussie and the US dollars, on the day itself, it could be already moving 70 to 80 pips already. So if you were to only give 50 pips, then via the DCI, the chance of a conversion becomes very high and particularly risky for the client. And therefore, we actually generated the power DCI that actually allow the client to actually strike it even further away. And therefore, even if you get it converted, you can actually convert it at a higher value, right? The downside of the power DCI is that should the Aussie dollar goes below 73.90 in this particular example, then the client do not actually get any coupon. Yeah, they do not get any coupon if it goes below. Yeah, but as long as it stays within the range, the client will actually get a coupon. Yeah, and again, if the Aussie to US dollars goes above 75 cents, again, this is also a scenario where coupon is actually not paid. Yeah. So again, I think if you were to strive for capital gain and you want to hit higher strike level, then power DCI would actually allow us to actually do that for our clients. Then the second strategy that we have is to ride on the recovery cycle. Now, as we have actually shared earlier, the recovery globally is still intact. Globally, despite the Russia and the Ukraine war, we still anticipate and expect the world to grow. Well, yes, it could be tweaked a little bit. It will be dialed down one notch or two, but global growth is still pretty much intact. Because if we were to look at mobility around the world, the global mobility is continue to improve, and therefore we continue to believe the recovery cycle is still pretty much intact. Over here, of course, when we actually look at the equity link or the ETF link, in terms of recovery cycle, what do we want to actually focus on? We are actually recommending the financial sector. Yeah. So via the ETF, if you do not want to pick a specific stock, to actually take a view, then we look at ETF, right? It's an exchange traded fund that actually look at a basket of equities that is linked to financials, and this is actually a financial ETF around the world. Yeah, and with this, I think the client will actually get a knocked-in level of 68%, which I think, as long as the recovery cycle is intact, I think the financial ETF will definitely be holding up well. And over here, the tenor is only slightly longer at 18 months and still paying a coupon, a very decent coupon at 7%. Nearer back to the our country, nearer to us, we can actually also look at the financial, looking at a basket, combining CIMB and also RHB, for clients that is more comfortable with our local names, or rather, if you were to look at, hey, stocks in Hong Kong has actually taken a beating, you would think that it would be a good time to enter. Then we could also be looking at ICBC and also HSBC combined as a basket to issue it as a equity link. Now, all in all, I think we like financials because in a rate hike environment, in a rate hike cycle, we actually believe if you were to look at the past, the cycle, the economic recession coming back into the recovery stage, financial usually will take lead in the recovery cycle. Yeah, and therefore I think our focus is going to be riding on the financial sector. The third strategy is actually keeping your principal safe. To keep your principal safe. So here we are actually targeting or rather develop a product that is principal protected in nature. Yeah. In this case, because the principal is protected, we couldn't keep it short, but principal is protected. Yeah. We got to launch this as a 6 years product. And it's actually linked to a Clibo, a ringgit Clibo, so something that is close to our heart. Again, of course, most of us will be concerned about Bank Negara hiking the interest rate, and therefore, if you were to look at the current situation, and this is where the opportunity opens up for us, because the market is anticipating that Malaysia Bank Negara is going to be hiking the interest rate. A lot of those expectations is already being priced in to the product. And that is why, today, while the OPR is still below, or the OPR is still below 2%, while the Clibo is still only slightly below the 2%, the 3 months Clibo is still below the 2%, we are now saying from second year onwards, the range can be stretched all the way to above the 3% already. And that is showing you, a range or rather a rate hike that is actually more than 1%. Yeah, more than 1%. While on our forecast, we are only believing that there will only be 0.75% rate hike over a period of 2 years, from 2022 to 2023. So we think, if you are also in line with our expectation of forecast, then I actually think that this particular structure would actually be making a lot of sense to our clients. Importantly, is keeping the principal safe. The last strategy that we have is diversification. It's diversification. Now over here, of course, I'm actually showing two ringgit issuance in KL Kepong Berhad and also PKNS. We have this available for sale. PKNS, we liked it. It's very, very short dated for 2 years. KL Kepong is rather long, but I think with the name, I think most clients would definitely know what is, who is KL Kepong, right? And with commodity price rising, with palm oil rising, I think, if we are going to say that, is there any credit risk for KL Kepong? I think very unlikely that will actually happen. And therefore, I think we like these two names and we thought we want to share. But I think importantly, what we want to share in terms of diversification is actually the dollar, the bonds. If you were to look at it, the dollar bonds is actually the AT1s in nature, and they are all financial names. And most importantly is that the yield that we are able to provide is above the 5%. If you're able to take a little bit more risk, going down to the BB, although it's still an IG rating, we could be seeing the yield being pushed closer to the 6%. But again, all in all, why are we showing a dollar bond as diversification is because today in Malaysia, the MGS, the government holdings, is actually almost 40% of our Malaysian government securities are actually being held by foreigners. Now, we actually believe that if the US were to start hiking aggressively, as per what they mentioned, then we could actually be seeing some of the foreign investors selling down the bonds in Malaysia to actually reinvest in the US treasuries or the US securities. And when that actually happens, you will find that the Malaysian ringgit would definitely will take a step weaker, and therefore the going to the dollar bonds would actually allow the client to diversify some of the investment to others.
Right.
So yeah.
Hi, thanks a lot, Glenn. All right, so it's quite comforting to know that actually there's still a lot of options for investor to capitalize on at this current market situations. All right, so move on to our last question before we end the session today. All right, so there's a lot of growing concern all right, about the potential for stagflation. So what is your view on that?
Okay, thanks, Moo. I think when we talk about stagflation, it is something that is being hotly debated today. The more importantly, I think we are actually starting to see more and more the write-up saying that, hey, you know what, stagflation is coming. But I would like to actually point, and I did this specific, slide to point out to our clients that stagflation are actually pretty rare and remote, because stagflation is a culmination of a perfect storm in economic ills. Number one, you need to see a very slow economic growth, and you need to see high unemployment, and you need to see high prices. Most of the time, if you were to think about it, if you have a high unemployment, people are not getting jobs, right? They will not be getting, if they are not getting jobs, they're not getting salary, and therefore they will have less income to spend. And when they have less income to spend, then chances are we will think that, high prices shouldn't be the cause. It shouldn't happen because nobody is buying, because people are jobless, right? They are not getting salary, right? And therefore, high prices shouldn't even happen. On the other flip side, if you were to see high economic growth, right? The economy is really, bursting, right? And everywhere is running strongly, right? The manufacturing are, the full steam ahead. All the cylinders are firing. Then the next question is that if every industry is firing at full steam, honestly, we shouldn't really be seeing high unemployment, because people will be getting jobs because industries are running, the economy is running, services are running, then employment shouldn't really be the cause. So again, you can have one, but you can't really have both of them happening together. And therefore, we are actually saying that it's really a rare situation, and it's probably going to be very remote. Yeah. And so but doesn't mean that it won't happen. I think in the history of economy or economics in the world, we have only seen one time of stagflation, and that is actually happened in 1970s. And after that, we have never seen stagflation happening before. And I think the central banks today are actually cognizant of this particular risk. And I actually believe that they would definitely be on hand to ensure that stagflation is not going to come into the system. Because if you were to look at the 1970s, how do we actually get out of stagflation? You need to actually trigger a recession. And again, I think we are still of the opinion that the recovery is still pretty much intact. I think globally, I think we are still on path of recovery. And probably you won't see people talking about recession. But if stagflation were to happen, you need a recession. So again, two can't happen at the same time, right? And therefore, we are actually maintaining our view. It's a rare situation, and it's probably going to be very, very remote. Yeah.
Right. Great. All right. So good to know that stagflation is not happening anytime soon. All right. So I think that's wrap up our today's discussion. All right. Thanks, Ken, for the insightful sharing. All right. So now we will take some questions from the chat box. All right. So there's a couple of questions here. So I'll start off with a question from, all right. So what's your view in global market, especially US? Is it too expensive to go in now?
I think on this particular view, generally, if you were to look at the US, we have not been seeing a correction. I would like to see a correction for the US. But definitely, if we are just able to continue to see growth happening in the US, then I think the US equity market is still a place where we can still enter. But if we are just going to see the growth slowing down and not as fast as the central bank actually predicts them to be, then I think we should actually aim to see a correction for the US market before it actually head up higher. As of today, if you are asking me if is it too expensive to go in, I would like to think that it is probably on the high side, probably waiting for correction before you should really be going in. Yeah.
All right, thanks, Ken, for the answer. All right, next question is on the sanction on Russia. All right, so would it affect the shipping insurance for transporting those items like fertilizer and energy? So, right, so if that's the case, would it further affect the supply of those input items to third party outside of the country that are imposing sanctions to Russia?
I think in this particular topic, it is still very, very fluid. It is still very fluid because if you were to look at the sanctions, the EU, the US is still talking about imposing more and more sanctions, right? Importantly is right now, at least I would like to think at least right now we probably would can breathe a little bit easier after the US is seen to be going less harsh on China in terms of sanction. And in terms of sanction, we are actually just looking at globally versus the Russia. Would it affect shipping insurance? I think definitely it would. Particularly on fertilizers and energy. In fact, it is already short in supply. If you want to insure those items that is priced, I'm pretty sure the insurance will definitely be going higher. But again, I think in terms of sanction and in terms of supply, I think it remains very, very fluid. With regards to the Russia-Ukraine, as we go along, we continue to believe that this war is not going to end immediately. The sanction will continue to go on. It's just whether we will see the sanction being escalated or de-escalated. The other good point that we are probably seeing some light at the tunnel is that the negotiation between the Ukraine and the Russia is going quiet. Nobody talks about it today. And this is probably good because if you were to notice at the start of the negotiation, every time they couldn't even get any traction, they will come out to the press and say negotiation is not going well, right? But today we are not hearing that, right? I would like to think that the negotiations are in fact progressing decently. So I would like to hope that there won't be more sanctions happening for Russia. Otherwise, I think it could actually to aggravate the inflation situation that we're actually seeing today.
All right. Okay. Next question is about China. So what's your assessment on China market? All right. So with the current lockdown in certain provinces due to COVID-19, is China still attractive for investors? This is the first part of the question. Second part is about your assessment on India and ASEAN market as well.
I think there are two questions which relates to the China, the market outlook. I will probably take both of them together, right? Now, I would like to, in fact, early of this year, we have actually also done a round of session with some of our clients. And one of the key points that we are actually asking our clients to look out for is actually the Chinese policies. Because for the past few years, we have actually seen China clamping down some of the industries, and China has been advocating their philosophy of shared prosperity, and therefore clamping down in some of the the industries like properties, right? And in some of the Alibabas and whatnot, and the new technology companies, and we have actually seen the industries that the China clamps down is actually has actually corrected deeply, sharply. But importantly, we would like to think that after the big clampdown, I would like to put it, I think right now is where China is going to look at how they can help the Chinese economy to grow again, how they can actually help to actually the restart and actually boost the economy. And true to that, when we started talking about it earlier of the year, and true to that, I think last week the Chinese authority have actually came out talking about they will actually be supporting the equity market and supporting the industries. And in fact, the earlier of this year, we have also seen China relaxing and cutting some of the rates, the key rates in China as well. And that, it looking to me that the China is actually loosening some of its policy to actually support the market. So if you are asking us, if you are going to ask me, I'm probably going to say that China is definitely looking attractive today. And that's also the reason why in one of our strategy to actually ride the recovery, the wave, we are actually putting two Hong Kong listed stock there as part of our strategy.
All right, thanks, Ken. All right, next question is about the pandemic, COVID-19 pandemic. So since the pandemic is becoming a norm this day, all right, so will it still impact the market significantly?
I think as something that we have shared, I think we are just going to learn to live with the virus. Importantly, the virus has somewhat turned a bit less aggressive, starting with the Omicron, right? And as we see, the pandemic develops, I think most countries are now, wanting to move to the endemic stage. Now, of course, some clients is actually probably going to highlight that, but Hong Kong is looking like implement a big lockdown, right? And the death rate, is still high for Hong Kong, and in fact, the hospitalization, is being overwhelmed. The hospital, the healthcare is being overwhelmed. But I would also like to point out that Hong Kong, in terms of the vaccinated percentage, is also probably even lesser than Malaysia. So you can actually see a difference between taking the vaccine and not taking the vaccine. And I would like to also say that for a lot of the emerging markets, for a lot of the developed markets, I think the vaccination rate is looking healthy. And therefore, I think while the pandemic is going to be here to stay, I think it's going to be less impactful or rather adversely impactful to the economies. I think we will actually continue to recover. We will continue to open up. Mobility will continue to improve for Malaysia and for global, for that matter.
All right, I think that's all the question we have on the chat box. All right, so I guess Ken has covered many topics of interest and also shared some insightful information today. So we hope that you have found the event fruitful and informative. All right, so do have a chat with your RMs after this session if you need a review or even rebalance your portfolio to potentially maximize the returns. All right, so ladies and gentlemen, we have come to the end of the session. Thanks everyone for joining. We hope that you will have a wonderful week ahead. Goodbye, everyone.
Thank you. Thanks, Mo.
Thanks.
Here at Alliance Bank, we have discovered that true wealth lies not in the world or what it can offer. True wealth lies in the hard-working hands of a dreamer. True wealth is being around people who add meaning to our lives. These are the people who are always there for us, in times of success, and even in challenging times, they're always there. We have learned that through all of life, family is the one constant. And Alliance Privilege is just like family. Helping individuals tell their stories, helping families achieve their dreams, and helping generations share their legacies. Family and Alliance Privilege. The future's always better together.